Hey there, and welcome to Retire Your Way with ILG Financial. My name is Chase Lopez. This is Dave Lopez.
Hi.
And today, this video is really focused on financial literacy. Today we're going to talk about how we're in this brand new rising interest rate environment, and some investments out there are paying a lot more interest than they did not 12 months ago, right? CDs is a great example.
Yeah, let me interrupt because this is a great point. We have been talking with our clients for years about how interest rates move in waves, up and down, just like the stock market. And we have had low interest rates now for a very prolonged period. And we always expected interest rates to go up. The question was just when and how quickly would they rise. Well, after years, and I'm talking 10 plus years of low interest rates, they have now started to rise. And they may kick back down or they may continue to rise up, but for the first time in a long time, for any of you savers watching, folks who would rather not invest in the market, would get guaranteed returns, we've got an opportunity to get some good returns. So let's talk about the vehicles, the investment vehicles that are available that benefit most from rising interest rates.
So we'll start with CDs, or certificates of deposit. You've probably seen them at your local bank or whoever you bank with. I think right now, going CD rate for maybe a 3-year CD is approximately 5%, depending on your bank. And all that means is you say, hey, to the bank, they can hold your funds for 3 years and they pay you a stated interest rate. Whatever that interest rate is, they just pay you that stated interest rate. So to your point, Dave, as interest rates have gone up, the rates that they're paying out have also gone up.
Yeah, they were as low as around 1% or less for a 3-year CD. 12 to 24 months ago. I mean, that's a huge increase. 1% to 5% is kind of unheard of in that short period of time. And that's the one, by the way, Chase, that most folks are familiar.
Exactly.
Now, when you said, and I appreciate you saying this video and all of ours are really about financial literacy. Our belief is the more you know, the more power you hold, which can equate literally to more money in your pocket. And I can't think of a better video to explain that. So CDs, I love that you started with that, because that's the one most people think about. If they want safe, guaranteed, they go, well, I get to CD. Now, what we find interesting because we meet with so many folks, is most people believe that's really it. That's their only safe option. They got to go to the bank and get a CD, and it's not. The next one that are most familiar would be bonds. So you can have government bonds that are as safe as bank money because it's insured. You can have for a little more interest, usually, not always. You can have municipal bonds. That's from state or county governments, municipalities. Not quite as safe because it's not backed by the federal government, but taxpayers are going to guarantee it. Then you have corporate bonds. Both what's called investment grade. That's your biggest of your big companies. Very little risk of default. Imagine Coca-Cola or Apple. You're probably not going to see them go bankrupt, so it's pretty safe bet. Okay, and then you have companies that are a notch down the chain that aren't quite as big or secure financially, so they pay better interest. Those are called high risk bonds. You can get a little better.
High yield bonds, right, Dave?
High yield bonds. You get a better yield, excuse me.
Yes.
But that was an interesting slip. You get a better yield because there's perceived more risk, because the company's not as safe. So you can have what's called default risk. You don't have default risk with a CD as long as it's under $250,000 per bank. That's FDIC insured. You do not have default risk from any federal government bonds or treasuries notes because it's backed by the government's ability to pay their own debts, which is about as safe as we can get. Investment grade, any corporate bonds do have default risk, but they're very, very low. With investment grade, a little bit higher if you have the high yield bonds,
high yields.
So it's a little different. So those are familiar, and most folks maybe will have some bonds. Very different, I will tell you, how bonds perform in your portfolio as interest rates go up and down, whether you have individual bonds or bond funds. And most people don't know that. If you have a bond fund, it will perform very differently maybe than an individual bond. So check with your financial advisor on that. So those are two, if we said bonds and CDs, right? Those are two Here's the one that most people miss, and it goes to my point, Chase, of you don't want to lose money just because you don't know about a vehicle that's available, right?
That's
and
true.
Misinformation can cause people to lose money, and this is a great example. So talk about a fixed annuity.
Yeah.
Fixed annuity.
Fixed annuity. So it's a lot of people call it what's called a multi-year, so MY, guaranteed annuity. So MYGA is a acronym. Yeah, an acronym that a lot of people will see. And it operates very similarly to a CD, right, which is what we led off with. But instead of the bank holding your funds, right, this is just an insurance company holding your funds, right? So if you get a 3-year MYGA or a MYGA, right, they'll pay you a stated interest rate for that 3-year period. Once the 3-year period is up, they'll send you your principal plus the interest that it's paid. One neat little caveat with the MYGA as opposed to the certificate of deposit or the CD is that those during the time frame of the MYGA, the taxes are deferred over that time, right? So you don't pay the taxes until the end of the term, and they send you the money back. And a lot of times, the rates on an MYGA are a little bit more attractive than what you would see on a CD. So, for example, right now, an MYGA is paying 3-year is paying approximately 5.65%. So that's just one example.
And the CDs are probably around 5.
Right.
So the point would be not that a fixed annuity is better than a CD.
Right.
It's just a little different, but very similar.
Right.
The point is that if you can find a strong company, a big strong company, like your biggest insurance companies, and they're paying a better rate than your bank on the CD, if it operates the same,
right,
aren't you just losing money because you didn't know to ask about this tool, right? If it's not paying better, get the CD.
Right.
We're not saying get one or the other. We're saying don't lose money because you have a misunderstanding of how an investment tool works. Most people have no idea that a fixed annuity operates, like you said it best, almost exactly like a CD. Guaranteed interest for a small period of time and a guaranteed period, and then you take the money out and you can renew it for another period of time if you want or do anything you want with it.
Right.
That's one. Another one, of course, is another type of annuity that's benefiting right now from interest rates going up, and that's called a fixed indexed annuity. Now, how's that a little different? So we go to a CD or a fixed annuity or a bond because we like principal protection, right? We want our money protected and we're okay getting a little bit of guaranteed interest. Well, interestingly, a fixed indexed annuity, which like a fixed annuity and like a CD and like a bond, don't really have any fees.
Right.
The cost for all of those is
time.
Yeah, the longer time period you're willing to let them hold your money, whether it's an insurance company or a corporate bond or a bank, the more interest you get in theory usually, right? Well, with a fixed indexed annuity, the same thing happens. They guarantee your principal, just like the others, really no fee, the cost is time. But what they give you to do, if you're willing to take a little bit of risk with not on your principal, but on how much interest you get, instead of getting a guaranteed 5% CD, a fixed indexed annuity might give you the chance to earn anywhere from in a given year 0 to as 15 or 20% up to in a given year. But on average, those things usually are designed, if you're going to get 5% on a CD, they're designed that over time you're hoping to get 4 to 8 or 4 to 9 better interest because you're willing to take a little chance. But it's not guaranteed interest, but the principal still is. So it's kind of a nice middle ground, isn't it, between risking your money in the market or getting a guaranteed rate completely safe. So this would be another way to invest to get some of your money guaranteed safe in a CD or the bank or a fixed annuity. Some of your money in the markets with risk, not only your principal, but how much you grow. And then in the middle, you could have a little risk to try to get better interest than a bank or CD and a fixed indexed annuity, but still have the principal protection.
Yeah, and I think the big takeaway from our discussion here today, Dave, is just that in this new rising interest rate environment, there's just a lot of different tools out there that are benefiting from that, right? And really, there's no one tool that all of your money should be in, right? We want to diversify. So really, today is just showing the viewers here that there's other tools out there that we really haven't been attracted to because of that low interest rate environment, but are now more attractive because interest rates are higher.
Yeah, so get if you want to take advantage of interest rates going up, get with your financial professional.
Mm-hmm.
Ask him what vehicles he has available, or she has available to take advantage of rising interest rates. And specifically ask them if there's one of the 4 or 5 we mentioned today and they don't mention them, ask them about those, how they work, those zero fee ones.
Right.
Specifically, how they might fit into your plan.
Right. Thanks for joining us today. Go ahead and hit the subscribe button down below the video here. Also hit that alarm bell. That'll give you notifications for any future videos that we have. And we'll talk to you soon.
Talk to you soon.